You know, in the world of investing, what you see is almost never what you get. A fantastic headline can be hiding a really terrible story, and a number that looks like a total disaster, well, that can actually signal a brilliant strategic move. Let's dive into this paradox.
So let me just ask you this. Imagine a company reports its revenue grew a really solid 19% year over year. Right on the money, exactly what Wall Street was expecting. You'd think the stock would be fine, right? Maybe it gets a little bump, maybe it just stays flat. That makes sense.
Well, think again. The trade desk did exactly that, and its stock absolutely cratered, down almost 39%. But then you have Unity Software, which reported that its revenue actually went down by 2% and its stock soared over 11%. So what on earth is going on here? This is the puzzle we're going to unpack.
It's because the headline numbers just don't tell the whole story, not even close. Today, we're going to learn the art of reading between the lines, separating the good, strategic pain from a genuine operational failure.
Okay, so our first lesson comes from the world of digital assets, where we're going to apply something called the profit quality test.
Let's kick things off with Coinbase. They reported a quarterly profit of, wait for it, $1.4 billion. I mean, that is just a huge, impressive number.
Now, this is their official GAAP profit. It's a number you're going to see in all the headlines, and on the surface, it looks amazing. But let's peel back a layer.
Because when you strip out all the one-time stuff and just look at the profit from their actual day-to-day business, that $1.4 billion number just evaporates all the way down to $33 million.
So how does that even happen? Well, this is a classic example of what analysts call a profit illusion. That massive $1.4 billion figure didn't really come from their core business. Nope. It was almost all a one-time paper gain from their investments, especially their stake in a company called Circle. It's an accounting quirk, not a sign that business is booming.
And this is where you find the real story. While that headline number looked great, Coinbase's actual business was getting hammered. Transaction revenue, trading volume, consumer volume, all down dramatically. We're talking 40–45% in a single quarter. This is why the market punished the stock. It saw right through that illusion.
Now, let's look at Circle, the very company that propped up Coinbase's profit. Circle posted a headline loss of $482 million. That looks awful, right? But the reality underneath, it was the complete opposite of what was happening at Coinbase.
And this gets us to this really key concept of profit quality. See, high-quality profits are sustainable. They come from the company's main business, the thing they do day in and day out. Low-quality profits, like that big one from Coinbase, are often just one-offs that can hide some serious underlying problems.
So where did that giant loss at Circle come from? It turns out the whole thing, every penny, was caused by a $591 million non-cash expense tied to its upcoming IPO. Think things like stock-based compensation. It's a paper loss that has absolutely nothing to do with how the business is actually doing.
In fact, if you just look past that accounting noise, Circle's operations were on fire. The circulation of their stablecoin, USDC, was up 90%. Adjusted profits up 52%. Revenue up 53%. This right here is high-quality operational strength, and you better believe investors absolutely loved it.
All right, let's switch gears and move to our next case study. We're going to see how this exact same dynamic plays out in the hottest sector on the planet right now, artificial intelligence.
There is absolutely no doubt we are in an AI boom. I mean, the management of Lumentum, which is a key supplier in this space, they put it perfectly. They said we are at the beginning of a multi-year supercycle. The demand for AI infrastructure is creating this massive tailwind for the whole industry.
But here's the thing you got to remember. A massive tailwind does you no good if your sales are full of holes. Just being in the AI space isn't a guarantee of success. Just look at this contrast. You've got Lumentum successfully riding that AI wave, beating expectations, raising their forecast. But then you have BigBear.ai, a whole different story. They didn't just miss their numbers, they missed them by a mile. Earnings miss? Over 1,000%. But the real killer, the thing you have to look for, is that last row. They completely withdrew their future guidance. That tells investors that management itself has no idea what's going to happen. They're flying blind. This isn't a bad quarter, it's a catastrophic failure of execution. And now for our final and, honestly, most dramatic examples. We're going to look at companies that took on these huge, painful-looking losses, not because they were failing, but as part of a deliberate, incredibly high-stakes strategy.
I want you to imagine opening up an earnings report and seeing that your company's revenue didn't just dip, it got cut in half, a nearly 50% drop. That's exactly what happened to a little drone company called Red Cat.
But here's the twist. This collapse was not an accident. It was a choice. Red Cat decided to sacrifice everything, their current sales, their cash reserves, to bet the entire company on winning one single transformative prize.
Okay, so here's the strategy, broken down. Step 1, the sacrifice. They literally stopped selling their other products just to focus their resources. Step 2, the goal. Pour every single dollar and man-hour into winning the U.S. Army's official drone program. And step 3, the prize. If they win, they unlock a contract worth up to $260 million. It would turn them from a tiny company into a major defense contractor, basically overnight. They took the pain, and guess what? They won the prize. That is strategic suffering. So let's tie all of this together now. We've seen again and again that the story behind the numbers is what really, truly matters.
The real story is always in the why. Coinbase and BigBear.ai, they suffered from bad pain. That's the pain that comes from a weak business or just terrible execution. But the other stories, that was good pain. Remember Unity from the very beginning? Their revenue shrank because they were deliberately cutting unprofitable parts of their business to focus on what works. Smart. Or another company, Energy Fuels, took a loss on paper to build up its uranium inventory, betting that prices would go up. And of course, Red Cat took on that extreme pain to win a contract that changes everything for them. It's all about telling the difference between an operational failure and a strategic choice. So the next time you see one of those shocking earnings headlines, whether it's good or bad, the most important question you can ask isn't what the number says, but what story it hides. Thanks for tuning in to The Explainer.